The news is on in the background. It's always on. You don't know when that started. Level 1. The idea. You're not a trader yet. You're someone who reads too much and has started to notice things. You notice that when the Fed raised rates in 2022, your rent went up. You notice that the dollar did something when Ukraine happened. You notice that these things are connected and that the connection has a shape and that the shape moves before the headlines do. That noticing feels like power. It isn't yet, but it feels like it. You find a podcast, then a book, Dalio's framework, the debt cycle, the machine. You read it twice and underline things and feel like you've been handed a lens that most people don't have. You start watching bond yields the way other people watch sports. You open a brokerage account and buy a currency ETF because you think you understand what the dollar is about to do based on something you read about the Fed's balance sheet. It goes the wrong way. You hold it, it comes back, you close it at a small gain and feel like you've confirmed something about yourself. You haven't confirmed anything. You got lucky and called it insight, but the feeling is enough to keep you here. That's all level 1 requires, just enough to keep you here. Level 2, the student. You've been at this for a year. You have a framework now, or the shape of one. Interest rate differentials, current account balances, purchasing power parity, you know what a yield curve inversion means, and you bring it up at dinner and someone changes the subject and you let them because you're used to it now. You've read Soros, not just the quotes, the actual book, the reflexivity chapter you read 4 times and understood it differently each time, and you're still not sure you fully have it. You've read about the Plaza Accord, the 1992 crisis, the Asian contagion, the taper tantrum. You are building a library of how the world breaks. You open a small account and trade FX with real money, not much, enough to feel it. You have a thesis on the yen. You've read the BOJ policy documents, cross-referenced Japanese inflation data, looked at the carry trade positioning. You enter. The yen moves against you for 3 weeks, not because you were wrong about the fundamentals, because a Fed official said something at a conference you didn't weight correctly and the dollar ripped and your position got stopped out 4 days before the yen reversed exactly as you predicted. You sit with that for a long time. You were right about the destination. You were wrong about the path. In macro, that distinction will cost you more than you're ready to pay. Level 3, the apprentice. You got a job. Not at a fund, not yet. At a research firm, small, 12 people, mostly writing. You spend 8 hours a day reading central bank minutes and producing summaries nobody reads and building models in Excel that your manager adjusts without explaining why. You watch how he thinks. Not what he thinks. How. He doesn't get excited about ideas. He gets excited about asymmetry. He asks every time without fail, what does the market already have priced in? Because the question isn't whether you're right. The question is whether you're right in a way the market isn't already expecting. You can be correct about every fundamental and still lose money if the trade is crowded and consensus and the move already happened 6 months ago while you were reading the thesis. This is the thing that breaks most people at this level. The realization that being smart is not the edge. Being early, being different, sizing correctly, being willing to be wrong publicly and adjust without ego, that's the edge. Smart is just the entry requirement. You watch your manager take a position opposite to everything he said in a meeting 2 weeks prior. You ask him about it. He says, the data changed. You think about that for months. Level 4, the analyst. You're at a real firm now. Not a big fund, a mid-sized macro shop, 20 people, $800 million under management. You are one of 3 analysts. You write memos, you defend them in rooms where people push back hard and don't soften it. You learn to separate your ego from your thesis because if you can't do that, you won't last a year. Your first real call. You build a case for short positions on emerging market currencies, 3 of them based on dollar strength, tightening global liquidity, and capital outflow dynamics. You present it. The PM asks 14 questions. You answer 12 well and 2 badly, and he knows which 2. He takes a partial position, not because he fully agrees, because the risk reward is skewed enough that being half right still pays. It works. Not completely. 2 of the 3 currencies move as modeled. One doesn't and costs back a third of the gain. Net positive. The PM doesn't congratulate you. He asks what you missed on the third one. You tell him, he nods. You go back to your desk. That's the whole interaction. No celebration, no performance review bump, no moment. Just, what did you miss and how do you see it now? You understand for the first time that this is what the work actually looks like from the inside. Quieter than you imagined, more iterative, more honest about failure than anything you encountered before. Your social life exists in theory. In practice, you spend your weekends reading central bank speeches, and you've started dreaming about yield curves, and you tell yourself, this is temporary. Level 5. The PM, you manage a sleeve now. $200 million. Your own book, your own P&L. The number is yours to grow and yours to lose, and that distinction lands differently than you expected. You have 3 positions on. A long dollar versus a basket of Asian currencies built on a rate divergence thesis. A short on European duration based on fiscal dynamics you've been tracking for 8 months. A long on gold as a tail hedge against a scenario you think is underpriced by the market, a simultaneous policy error in both the Fed and ECB. You think about these positions when you're not thinking about them. They live in a background process that never fully closes. You take a loss in March. Not catastrophic. 4% of the sleeve in 11 days because a central bank you modeled as constrained made a move you had assigned 15% probability. The move was defensible in hindsight. The market had telegraphed it if you read a particular set of signals differently. You went back through everything. You found the signals. You had seen them and weighted them incorrectly. You adjust the model. You don't change the process. That distinction matters enormously. And you understand why, now in a way, you couldn't have explained 2 years ago. The loneliness is real at this level. Not dramatic loneliness, quiet loneliness. The kind that comes from operating in a frame of reference that very few people share. You can't explain your work to most people, not because it's secret, but because it requires so much shared context to have the conversation that you've stopped trying. You say finance and move on. Level 6, the senior PM, $1.2 billion. Your book has grown through performance and allocated capital, and the number still surprises you sometimes when you say it out loud, which you don't, because you stopped saying it out loud. At this level, you are no longer just reading the world. You are part of what moves it. A large enough position in a thinly traded currency pair, and you are the news. Your order moves the price you're trying to enter. You've had to restructure how you execute because of this, spread entries across sessions, use algorithms, coordinate with the desk. You've become an actor in the system you used to only observe. The intellectual work has deepened in a way that's hard to describe to anyone outside it. You don't just model economies now, you model the models. You think about what other large participants are likely thinking, how they're positioned, where the pain points are, where a move in one direction would force a cascade of stopouts that would itself become the move. You are playing chess and simultaneously trying to understand what game everyone else thinks they're playing. You are right more often than you are wrong. Your track record over 6 years is audited and real and speaks without you having to. And yet, the market has humbled you more times in the last year than in the 3 before it combined. Because the larger you get, the more the market knows you're there. And things that knew you were there don't behave the way things do when they don't. Level 7, the CIO. You run the fund now. $6 billion, 12 portfolio managers report to you. You spend less time on your own positions and more time on the architecture of how risk is taken across the whole book. Correlation, concentration, factor exposure. You think in terms of the portfolio the way you used to think about individual trades. The meetings with investors are a different kind of work. You are translating a worldview into language that builds and maintains trust. You explain your thesis on dollar hegemony and multipolar reserve currency dynamics to a sovereign wealth fund that allocates $400 million to you. And you watch the faces in the room and calibrate in real time. You are performing competence while actually being competent and understanding that those are not the same skill. You have been wrong publicly twice in the last 3 years. Once on the timing of a European recession, once on the trajectory of Chinese stimulus. Both times the framework was directionally correct. Both times the market moved against you long enough to be painful before eventually proving the thesis. In macro, being right on a long enough time horizon and being wrong are functionally indistinguishable. If your investors can't hold through the drawdown, you know this. Managing their conviction is part of the job now. You miss the clarity of earlier levels sometimes. Not the money, not the size, the clarity. When the question was just, what does the world look like and where is it mispriced? Now, the questions are layered over each other and none of them have clean answers. Level 8, the apex. It's a Tuesday. You're in a meeting that will affect the positioning of $11 billion. And you are thinking about something someone said to you 11 years ago, your first manager, the one who adjusted your models without explaining. He said, the market is always right about price and always wrong about meaning. Your job is to know the difference. You've spent 11 years figuring out what that means in practice. You're still figuring it out. That's the part nobody tells you. You don't arrive. The mastery, to whatever extent it exists, is the continued practice of not being certain. Every level of this gave you more tools and more conviction. And at the top, on the other side of all of it, what you have is a very sophisticated relationship with uncertainty. That's it. That's what this built. You manage more capital than the GDP of several countries. You have a team of 43 people. Your macro views get quoted in financial media. You've testified once before a parliamentary committee on currency markets. You have access to conversations that most people don't know are happening. And the market humbled you 6 weeks ago, cleanly, directly, without ceremony. A position you'd held with conviction for 4 months, built on what you still believe was sound analysis, moved against you in 10 days during a liquidity event that repriced everything. You closed it, you absorbed the loss, you went back through the thesis and found one assumption that was load-bearing and wrong. Not wrong in the fundamental analysis. Wrong in the timing of the mechanism. Right conclusion, wrong clock. You've been wrong about the clock your entire career. Everyone at this level has. The ones who lasted learned to size for it. The ones who didn't are no longer here. You look at the room around you, the analysts, the PMs, the risk team. Somewhere in the city tonight, someone is reading Dalio for the first time and underlining things and feeling like they've been handed a lens that most people don't have. They're right that most people don't have it. They're wrong about what it gives you. It doesn't give you the answer. It gives you a better set of questions. And the questions get harder the longer you stay. And the market, which is just the aggregate of every human trying to be right simultaneously, stays one step ahead of your ability to model it. Not always, not by much, but enough. That's the irony you couldn't have been told and wouldn't have believed. You got very good at something that cannot be mastered. Every tool you built gave you a sharper view of how much you still can't see. The humility isn't performance. It's the residue of 11 years of evidence. The meeting ends. You walk back to your desk. You pull up the positions. You read the data. You think. Somewhere, someone is watching a yield curve for the first time and feeling like they've found something. They have. They just don't know what it costs yet. They'll learn.